Hi, this is Richard Day with Tycho's. Happy New Year. And in the spirit of the moment, we're going to make 5 fearless predictions for the economy in 2026. But perhaps I should label this fearless predictions about what won't happen to the economy in 2026, since there is a seemingly endless stream of blogs and podcasts predicting an economic crash, or rampant inflation, or the demise of the dollar, or worse. So here are ours. Prediction number 1. How Congress deals with the health care costs paid by households will be the biggest factor in the economy and in the elections in 2026. And it's difficult at this juncture to predict that outcome. A majority of the 24 million households on Obamacare marketplace plans face major increases in their health care costs due to the expiration of Biden-era subsidies. And over 10 million individuals will be losing Medicaid benefits as a result of Trump's big, beautiful bill. It's estimated by 2034, nearly 14 million more households will be without health care insurance altogether, with adverse downstream impacts on emergency centers and rural hospitals and much more. I'm going to continue to assume that the Republican Party stops short of falling off this electoral cliff and does something to keep intact most of these benefits. But there doesn't seem to be a lot of focus on it at the moment, what with invasions in South America and the like. We'll be coming back to you hastily if it does. Prediction number 2. The trade deficit may get some amount better, but not much, in spite of the avalanche of tariffs the U.S. has imposed. Why won't it? Well, first of all, we've had to back off substantially from the Liberation Day tariffs of April 2nd, in no small part because we didn't have the trade leverage we thought we had, especially with China, where little things like their chokehold on critical minerals have stopped us in our tracks. And these tariffs are now bringing a potential voter backlash from their impact on prices, and the administration appears to now be responsive to this backlash. Second, we've made almost no government-led investment in building up our own U.S. manufacturing capability, which we have argued is a necessary prior step or ingredient to a successful reshoring of manufacturing. So even where manufacturing has been forced out of China by our trade policies, it has gone to places like Vietnam, Mexico, and Turkey instead of the U.S., since we're simply not ready to take it on. Third, there have been a plethora of unintended consequences since our tariff strategy has been effectively disjointed. For example, Mexico's trade surplus with the U.S. has actually increased directly as a result of our new tariff structure. Fortunately, Trump has backed off on tariff after tariff, and I simply can't believe there's not a flood of back-channel conversations by CEOs to the White House, and I think this White House has done a good job of listening to CEOs, but a lot of conversations in the background warning the Trump administration off the worst of these tariff catastrophes. But who knows? Most think that the big tariff increases are over for the time being, even though the threats may still come out from time to time. And they note that the actual effective tariff rate is up from 3% previously, but nowhere near the levels once threatened. Prediction number 3, we won't have a GDP crash like we had in 2008 or anything close to it. In 2008, the economy contracted by 2.5%. But that was because leading up to that year, we built 2 million extra homes destined to sit empty and unsold, and household debt had grown by $5 trillion, effectively doubling as we did that. The two statistics most important to understand the fundamental resilience of any developed economy are private sector debt and real estate overbuilding. And both of those are currently in reasonable shape in the U.S. Household debt, including mortgage debt, is now at 67% of GDP, down from 98% in 2008. And business debt, including commercial real estate debt, is now at 72% of GDP, down slightly from the 75% in 2008. And by our estimate, we are now somewhat underbuilt in housing in other areas of real estate, not grossly overbuilt as in 2008. Business and household balance sheets are in decent shape. The 4.3% linked quarter growth in third quarter GDP, which by the way was 2.3% for the full year, the same quarter over the same quarter in the previous year, is evidence of this underlying resilience. Now, we may very well have a stock market correction since the AI boom has gotten ahead of itself and stocks are valued at all-time highs. But stock market corrections are not uncommon. We've had 5 since 2008. And the stock market is, in fact, a different thing than the underlying economy. Even in the terrible Internet 1.0 crash of 2002, where the S&P 500 was down 45%, GDP was actually up slightly for that year at 2% growth, believe it or not. The AI crash, if and when it happens, will hurt, especially those directly connected to it. But the AI sector and AI debt are a relatively modest percent of the total economy as compared to real estate, which is the largest non-government sector of the economy. So as Judy Garland famously suggested in the vastly underrated musical Meet Me in St. Louis, we'll have to muddle through somehow. A friend of mine recently rebuked me when I said this, saying his kid's college education was dependent on the stock market. My meek rebuttal was that investment textbooks cover the topic of diversification for a reason. Prediction number 4. There will not be mass job losses in 2026 from the AI-based automation, though there will, of course, be some. It should be noted that we've been losing jobs to AI for 30 years or more. I myself was involved with successful efforts to use AI to replace or increase the productivity of loan credit analysts and fraud detection analysts in the 1980s, obviating hundreds of white-collar jobs. So the impact of AI has been there bit by bit for years, even though it might very well accelerate somewhat now. But AI, whether large language-based models or small data-based models, is not nearly well enough developed to bring the level of change posed by the most gung-ho forecasters. Our view is that those breakthroughs in technologies bring less change in the short term than believed, but more change in the long term than envisioned. That long term is likely 3 to 5 or even 10 or more years out. Currently, sales of AI-based products such as Microsoft's Copilot are falling noticeably short of expectations. If we do see big job losses anytime soon, it will be from a normal economic slowdown or recession. Or, ironically, if from AI, it will be companies laying off some of the many engineers hired to overbuild AI systems. If you have a contradictory view, please do share. Prediction number 5. The government spending deficit will not get much better, if at all. Let's face it, DOGE, as disruptive as it was, failed to cut government expenses in any meaningful way. So government debt will continue to grow, but that will not bring skyrocketing inflation, despite the predictions of so many doomsayers. In fact, we can't find any evidence of a causal link between government deficits in developed economies and rising inflation, and plenty of evidence to the contrary, in spite of the fact that everyone seems to believe that there is one. If you have any such evidence, do tell. You can use the comments section to do so. Now, we don't love deficits, but for a different reason than most. They increase inequality, a subject we covered in our September 26th video. It follows that we don't predict much, if any, increase in interest rates. Bonus prediction. 2026 will be another great year for defense contractors, including the many startups that have poured into the space, since we suddenly have our hands full with Venezuela and perhaps in the near future, places like Cuba or Colombia or even Greenland. And for all the talk of the recent peace agreement in Gaza and the imminent peace agreement in the Ukraine, The fighting in both places will continue, not to mention the portent of new fighting in Nigeria and the possible continuation or resumption of fighting in Yemen, Syria, Iran, Cambodia, and the drug wars in Mexico and other parts of Latin America. Seems they changed the name back to the Department of War for a reason. We could go on, but that's enough predicting for today. Let us know if you want our predictions for any other areas, or if you have data to contradict any of the views we've expressed here. And so, as in the immortal words of Shakespeare, once more into the breach, dear friends, once more. Thanks.